Hey, good day, everyone. Welcome to another Gables tax planning webinar. My name is Bert Salazar, and I will be your host today. We're going to be doing a fairly short webinar because I'm going to be sharing, the type of work that we have actually done for specific clients, but we're going to be discussing one client in particular. Obviously, I have changed the names in order to protect the innocent, because for us, having disclosure, making certain that we have confidentiality on our side of the house is very, very critical for the type of work that we do with clients. Now, what I obviously want to discuss with you today is tax planning. And tax planning is going to play a major role for all of you and for all of us, not only now, but for many, many years to come. Now, because we are a retirement strategist firm, we specialize in working with people that are anywhere between 5 to 10 years away from retirement, or many a times they're already in retirement. So I'm going to share with you what are some of the things that are going to be very critical for all of us to pay attention to as we prepare to proceed in the retirement process from a business perspective. Now, we're getting a number of people that are already logging in, but then again, I want to start on time. I don't want to make any of you wait. And what I'm going to do right now is I'm going to be sharing my screen with all of you so you can see some of the things that I'm going to be discussing with you today. So you should be able to see my screen in the next few seconds. And yes, let me go ahead and take you to a specific screen that I want to share with you. And here we go. All right, so if you're all seeing my screen there, you're going to see a tax marginal map. And that's a history of taxation in the United States. Obviously, the red that you see there has been the highest marginal tax bracket in the history of our country since 1911. So as you can see there, if you go to the left-hand side toward the bottom, notice at the very beginning of the tax code, back in 1913, which was when it was finally enacted and implemented, the tax rates were very, very small at that point in time. And then obviously tax went up significantly, and then they went back down again during the Great Depression of the 1920s and 1930s. We had the First World War that we had to deal with, and then obviously we had an impact that lasted a long time from there. But then after the late 1920s, see what has happened to taxes all throughout the United States. As a matter of fact, one of our former presidents, Ronald Reagan, only would do 2 movies a year. And the reason why he would only do 2 movies a year was because there was a point in time right around the war, the early 1940s, where the highest marginal tax bracket in the US was 94%. Now, if you made over $200,000 at that point in time, then the highest marginal tax bracket was 94%. Now, although not that many Americans were making that kind of money at that point in time, Ronald Reagan was one of them. So he would only make 2 movies a year. He would be done by either August or September, and then he just wouldn't make any more movies, because then he would wait till the following year, because otherwise he was only going to generate 6 cents out of every dollar, and those 6 cents went to the state of California for state income taxes. Now, if you notice on the right-hand side, and this actually goes to 2017, so it doesn't include the Tax Cuts and Jobs Act of 2017 that took effect as of January 1 of 2018, we're actually living in the 3rd lowest tax bracket grouping in the history of our country, other than the Great Depression and then the very beginning of the tax code back in 1913. Now, the reason why we at Gables Tax Planning Group, we engage all of our clients and we do seminars and webinars and podcasts through one of our affiliate companies, and we are always discussing the issues and concerns of retirement in the 21st century, and then how to mitigate the tax liability in the 21st century and for years to come, is that, the way that we're looking at the taxes today is something that is going to have to change dramatically in the next 10, 15, 20 years, perhaps even 30 years down the line. And the reason for that is very simple. When you look at the national debt today in our country, which exceeds $21 trillion and counting, by the way, in 2019, for the first time in history, the servicing of the national debt is going to increase to $1 trillion a year, and that's an enormous debt that we have to deal with. But it's not only the national debt. You know, if you take a look at the unfunded liabilities, and in another video, I'm going to be sharing with you all the different costs and all the different increases in cost on our national debt and the unfunded liabilities. But when you take a look at the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt, it actually exceeds $114 trillion a year. $114 trillion. Yes, you heard me right. $114 trillion. Now, the question is, well, what does the unfunded liability really mean? Well, it means that these are the promises that the U.S. government has made to all Americans, and they don't have the money to pay for it today. So obviously, those are things that are going to be critical to understand, because at the end of the day, the only way that the U.S. government can generate revenue is an increase in the taxation of the revenues and the revenue through taxation that they have coming to them. Now, obviously, you can grow the economy, but you can only grow the economy so much, but the debt is going to be there for many, many years to come. So David Walker, who was the Comptroller General of the United States up until 2008, said 10 years ago before he quit that if the only way for the United States of America not to go into bankrupt in the very near future, taxes would have to double. Now, if you're in a 15% tax bracket today, or the 12% under the new tax law, if taxes were to double to 24%, what is that going to mean to you and your family? So managing taxation, not only now, but also for the rest of your life, is going to be very critical for the majority of you that are watching this webinar and are participating in this webinar as we move forward. The other thing to consider when it comes to managing taxation is that if you're able to manage taxation properly, then you're going to have more and more of your money working for you, your family, and your business, and that money is going to last a lot longer than if your tax rates and your tax brackets are high. Now, the other thing I want to share with you before I actually go into that client that I want to discuss and take you through is that when it comes to taxation in the United States, there are three major buckets of taxation, and you've heard me say this many a times before. You have the taxable bucket, the tax-deferred bucket, and the tax-free bucket. The taxable bucket is where a lot of our savings and checkings and CDs go into. You know, the money that you put in is after tax. The money grows in whatever amount it grows to on any given year. You're going to receive a 1099, and you're going to pay taxes on that money every single year along those lines. Now, from a taxable perspective, the taxable bucket is not a very good bucket to have. On the other hand, is a bucket that provides full liquidity, and we all need to have a percentage of our assets fairly liquid. So liquidity is very, very important, but the taxable bucket does create that. And because of the tax liability in the taxable bucket, we want our clients to limit the amount of money that they have in that tax bucket as they move forward. Usually about 6 months of fixed and variable expenses. Maybe you want to have a fudge factor for a little bit more for investments and opportunities, but not much more than that. The second bucket is a tax-deferred bucket. And everyone knows a tax-deferred bucket because the vast majority of Americans use these buckets in order to put away their retirement money. That's where your 401ks, your 403bs, your IRAs, your pensions go into. The money that you put in that bucket goes in on a pre-tax basis. The money grows tax-deferred, but then when you pull the money out, you have to pay taxes on the whole thing. Now, one of the fallacies is that when you put money in a qualified plan like a 401k or an IRA, one of the fallacies is that you're saving money on taxes. then you're not saving a single dollar in the tax deferred bucket. All you're doing is you're postponing the tax. And when you postpone the tax, you're also postponing the tax liability. So if based on all the debt that we have in this country and based on the forecast of all the experts and all the economists that deal with this every single day, taxes are going to have to be a lot higher in the future than they are today in order for us to mitigate all of those liabilities that we're going to be seeing coming down the pike in the not too distant future. Now, if that is the case, why would you want to defer the tax liability today so you can pay it at a higher tax liability and bracket in the future? Now, the second fallacy there is that, advisors will say to their clients, well, you're going to be in a lower tax bracket when you retire because you're not going to be earning as much, so you should be okay. Well, that's not a correct answer to give, because number one, the only way you're going to be in a lower tax bracket is if you have been a financial failure for the vast majority of your life. Otherwise, you're going to be either in the same tax bracket or a higher tax bracket. And the reason for that is that all of those tax deductions and exemptions that you were able to take advantage of prior to retirement, they're pretty much going to be done away with or gone by the time that you retire. So the deductions that you would get on your mortgage deductions, if you had children in the house, those exemptions and deductions are going to go away. If you are making contributions to your qualified plans, IRAs and 401ks, now in retirement, you're not going to be able to do that. So you're not going to be able to take those deductions either. And then last but not least, if you are making charitable contributions and taking deductions for charitable contributions, one of the things that we have noticed by reviewing many of our clients and obviously looking at the industry overall, is that the vast majority of Americans, when they retire, they start shifting from making actual physical and dollar-wise contributions to charitable organizations, where now instead of doing that, they're devoting more and more of their time to charitable events and so forth. So they're devoting more of their time, but time is not tax deductible from an IRS perspective. So because of the potential tax liability in the tax deferred bucket, we also want to limit the amount of money that most of our clients have in those buckets and that you should have in those buckets. In a perfect world, you don't want to have any more between $500,000 to $600,000 in your tax deferred bucket because of all the liabilities. The other challenge with a tax deferred bucket is that not only does it increase your tax liability, because every dollar that you pull out of that bracket, you're going to have to pay federal income taxes on, unless you've done proper tax planning, but it's also going to have a negative impact on the taxation of your Social Security benefits, and then ultimately the premium that you would pay for Medicare when you reach the age of 65. And then the last bucket before we get into the actual case that I want to discuss with you is the tax-free bucket. Whatever doesn't go in the taxable bucket or the tax-deferred bucket should all go into the tax-free bucket. Now, the tax-free bucket is a bucket where the money that you put in is after tax. So you've paid the taxes on that bucket. The money grows tax deferred, but then when you pull it out tax free. So it's a very good balancing to have. Now, the biggest bucket that you should have in your overall financial bucket system should be the tax-free bucket from a business perspective, because the money that you're going to be able to pull out will be tax-free. There are only 4 vehicles under the IRS code that you can have in that bucket, and that would be your municipal bond funds, your Roth IRAs, your Roth 401ks, and your 7702 plans, which are cash value life insurance plans that will maximize the internal rate of return for the bucket. Now, because of those features and benefits, we use 7702 plans to do all kinds of things because of all the tax benefits that it has under the IRS code. Now, what I like about the tax-free bucket, except for the municipal bond fund, because although income from a municipal bond fund is federal income tax-free, it does get added on to the provisional income calculations that we'll discuss in the next few minutes in order to determine what percentage of your Social Security benefits will be taxed in retirement. Now, the other three vehicles inside the tax-free bucket, the Roth IRAs, the Roth 401ks, and the 7702 plans, do not have a negative impact neither on your Social Security benefits at time of retirement or your Medicare premium when you reach the age of 65. So again, understanding how those buckets work and balancing the amount of money and contributions that you're making into those buckets will determine how good your life is going to be in the future. So what I'd like to do now is I want to take you to an actual case that this is an actual client that I have worked with, and we have many of these clients along those lines, but I thought that this would be an important client to bring to your attention because this is a client that I started working with approximately 8 years ago. And at that point in time, we started to do a shifting technique or a shifting straddle in which we started to shift more and more money out of the taxable and the tax deferred bucket onto the tax-free bucket. Now, this is a husband and wife. They're filing, they're doing a married filing jointly status. This case I worked on this year. So this is a fairly new case. It was at the very beginning of the year. And we started to do all those calculations. Now, the software that you see there, it's a tax planning, tax forwarding calculator and software program that allows me and my firm to be able to project not only your taxes for this year, but to project the taxes, for many, many years to come. So whenever we do tax planning for a client, although we also do tax preparation, but it all goes together. We want to make certain that not only do we do tax preparation, but that we also provide tax planning, because if I can reduce your tax liability, and I can do this on an annual basis, then I can increase your retirement income by at least 25% without you having to take any additional risk. So this client that you see in front of you, husband and wife again, they're age 65. And when they came in to see me this year for a review, their goal, they're already in retirement. So, what they were doing is we had created some Roth IRAs, some Roth 401ks for them, and also 7702 plans. So these clients were generating on a tax-free basis, approximately in this particular case, they were generating $72,000 a year tax-free. But in addition to that, they were planning to do some traveling and so forth. So they wanted to take an additional $50,000, as you can see there, out of their IRA. And the reason why they wanted to take the $50,000 out of their IRA was to compensate for some of the things that they wanted to do, because, when you get into retirement, you go into what I call the go-go years, the slow-go years, and the no-go years. Between 65 and 75, you're still healthy. You want to travel. You want to do a lot of things that you haven't done before. So you're going to go on the go-go. You're going to be on the go-go all the time. So I call that the go-go years. Once you get into your mid-70s, you're staying closer to home. You want to stay closer to your children, to your grandchildren. So now you go into the slow-go years. So from the mid-70s to the mid-80s, you're in the slow-go years. And then once you go past the age of 85, you are in what we consider the no-go years. Obviously, you're not going to be as healthy as you were 20 years earlier, so you're going to be staying close to home. You may do a little bit of travel here and there, but it's going to be, short distance traveling and so forth. But for these clients between the ages of 65 and 75 is a go-go year, so they wanted to take that additional income out of their IRAs in order to mitigate their liability. Now, they did not want to take any income from Social Security. And the reason why is because they wanted their Social Security benefit to continue to grow. And obviously, they can pick up an additional benefit. So at age 70, they can start dipping into their, Social Security distribution. And by doing so, then obviously their Social Security paycheck was going to be greater. One of the challenges that we get whenever we do an audit or a tax-preferred retirement blueprint for clients is that whenever they're making a Social Security calculation, or they're making a decision on when to pull Social Security benefits, they're only looking at those benefits through a microscopic view. We at Gables Tax Planning Group, we enjoy watching all of the finances through a telescope as opposed to a microscope, and I think you're going to notice and see the difference as we walk you through this case. So in this scenario, husband and wife in 2018, their taxable income, because whatever income they're pulling from the Roth IRAs, Roth 401ks, and the 7702 plans are non-reportable for income tax purposes, so they wouldn't have to pay any federal income taxes on that. So the only reportable income that they were going to have at this point in time was $50,000 that was going to come out of their IRA. As you can see there, under the new tax law, the $50,000 places them at the 12% marginal tax bracket. Now, there's a difference between the marginal tax bracket and the effective tax bracket, and we'll cover that in a minute, but the last dollar out of these $50,000, and the last dollar ended up in the 12% marginal tax bracket. If you see there toward the bottom, notice that the total tax liability was $2,430, and their effective tax rate was 4.86. So in reality, although these clients are paying taxes on the $50,000 out of the IRA, obviously they're not paying a tremendous amount of taxes. And the reason for that is, notice the gap that is over here between 0 and 20,000, or almost $26,500. That is the fact that now you have a much greater standard deduction under the new tax law. And then because they're age 65 and older, then they get an extra deduction for being age 65 and older, or being blind. But in this scenario, because of the standard deduction, their tax liability was going to be only $2,430. So when we had this discussion, and I had this discussion with the clients, my question to them was, well, how do you feel about this? And they said, oh, wow, Bert, this is incredible. I mean, we're taking off $50,000 out of our IRA. We're only paying $2,430 for an effective tax rate of 4.86, less than 5%. I will do this every single day of the week. And that doesn't include the additional $72,000 that we're generating that are totally tax-free. So when you factor in the entire income, the $2,430 was barely non-existent from a tax liability perspective. So obviously, when I visited with the clients, I said, well, let's see if we can go ahead, and let me make the advance over here. Let's see if we can improve on this scenario. And the reason why I wanted to improve on this scenario is because from a business perspective, my job as a retirement strategist and a tax preparer and tax planner is to try to get you and get these clients the most amount of income that they can generate without having to increase their tax liability whatsoever. So one of the suggestions that I made in this exercise, I said, look, if you're taking $50,000 out of your IRAs and paying $2,430 in taxes. By the way, $2,400 in taxes, that's not, it's not a lot of money, but at the end of the day, it's just north of $200 a month. That can be a car payment. That can be money for a vacation, for a long weekend. That could be a gift to a grandchild. That could be anything. Obviously, if you can legally avoid having to pay that tax liability, why not do so? So the suggestion that I made for the clients, I said, look, what would happen if we were to start taking Social Security benefits today? Well, Bert, if we take the Social Security benefits today, then it's not going to be as high as if I wait till age 70. And the answer is yes, but then again, you have less time to go. Because if you start taking the Social Security benefit today, and you know, you take it for the next 5 years, you know, you're 5 years ahead as the point in time that you're going to start taking it at age 70 if you decide to wait. So you got to figure out what's going to be the catch-up point, you know, what's going to be the break-even point down the line as you try to compare, did it make more sense to take the Social Security benefit at 65 as opposed to age 70. But now I'm going to look at it from a taxable perspective. So these clients, their Social Security, because I had done their Social Security tax calculation, which is one of the reports that we provide to our clients when we do a tax-preferred retirement blueprint, these clients could generate $35,000 in Social Security benefits at the age of 65. So therefore, if we can pull out $35,000 of Social Security benefits, then I only need to pull out $15,000 of IRA distributions. So if you think about it, take a look at on the bottom right over here. If I'm able to do it this way, here's what just happened. In the first scenario, which is a client just taking the $50,000 out of their IRA, they were going to pay $2,430 in federal income taxes for a marginal tax rate of 4.86%. Not a bad deal, but by just doing some strategic and straddle distribution planning design, I can get those clients the same $50,000 and have a total tax of 0 and have a total effective tax rate of 0 as well. And the reason why I'm able to do that is because notice that there's $15,000 coming out of their IRA. Now, you would say to me, well, Bert, I thought you told me that in the tax deferred bucket, when you put money into an IRA, the money that you put in is pre-tax, the money grows tax deferred, but then when you pull it out, it's tax free. And the answer is correct. Yes, you'd have to pay taxes on the distribution. What I didn't tell you, which is part of the tax preferred retirement blueprint that we do for our clients, is, you know, what if we have the ability to give you the best of all worlds? What if I can give you the ability to put money in a qualified plan on a pre-tax basis, have that money grow on a tax deferred basis, and then pull it out totally tax free? See, if I'm able to do that for you, then obviously you're in a much better position. And these clients now found themselves in a much better position than they were before they came in to do their retirement strategy session with me. Now, the $15,000 is taxable when it comes out, but I was able to offset the $15,000 with the standard deduction and then the additional deductions that the clients have. So in reality, the clients didn't have to pay a single dollar of federal income tax on a net basis on that same $15,000 of distribution out of their IRA. So obviously the clients, when they looked at this, they loved it. And then I did some Social Security projections where in this scenario, the fact that they're now taking the Social Security earlier and not having to pay taxes on the Social Security benefit, that means that their assets are going to last a lot longer. See, what Americans don't realize is if you have to pay taxes on your Social Security benefits, whether it's, you know, if 50% of your Social Security benefits is going to be taxable or 85% of your Social Security benefits is going to be taxable, that means that you're going to have a lot less in your Social Security income after you pay taxes. So you're going to have to take the money from somewhere else. So you're going to dip into your IRAs and your 401ks to take the difference. And by doing that, you're going to be accelerating the distribution of those assets, causing those assets to deplete to 0 anywhere between 5 and 7 years sooner than if you don't have to pay taxes on your Social Security benefits. So when I showed this to the clients said, well, Bert, this is awesome. You know, when can we get this done? And when can we get this started? And I said, well, hold on for a second. You know, maybe we can do better. So I said, look, we still have some standard deduction that we haven't used. And at the end of the day, if you don't use your standard deduction by the end of the year, then obviously you're going to lose some. Remember, because of the increase in standard deductions today, the IRS forecasts that anywhere between 25 to 30% of Americans are going to be itemizing. The vast majority of Americans are not going to be itemizing their expenses anymore. They're just going to take the higher standard deduction, unless your itemized deductions are going to be higher than the traditional standard deduction. So I said to the clients, well, what if we play this game and let's start to increase distributions out of your IRAs and see how many more dollars we can take out of your IRAs without having to pay any federal income taxes. So I'm up now to $18,000, as you can see there. There are no tax liability whatsoever yet. $19,000, now no tax liability at all. $20,000, no tax liability whatsoever. $21,000, that means that instead of having an income of $50,000, these clients now would have an income of $56,000. Instead of having to pay $2,430 in taxes, they get $56,000 of income and pay zero in taxes and have an effective tax rate of zero as well. And then obviously get to $22,000 under the new tax law, no taxes yet. And then once I get to the age of to $58,000 of income or $23,000 of IRA distribution, there's a little bit of a tax liability of $66. So let me bring it back to the $22,000 of IRA distribution. So think of it this way. In the first scenario, $50,000 of IRA distribution created a $2,430 tax liability. Now, $57,000 of a combination of IRA distribution and Social Security benefits provides a 0% tax liability and $0 of taxable income to the client. That is really, really a good world, good world to live in. And now the clients have an additional $7,000 that they can do anything with it. Now, one of the questions is, well, what can you do with the additional $7,000? Well, you can do a lot of things. You can take an extra vacation a year. You can put some more money into savings. You can actually do an IRA conversion. So you can convert to a Roth. That means you can actually think of it this way. You were able to put money in an IRA on a pre-tax basis, have that money grow tax deferred, pull the money out tax-free on a net basis because of the standard deduction calculations that we have done here, and then roll that money or convert that money to a Roth IRA in which now it will grow tax-free for the rest of their lives. That is having your cake and eating it too. Now, unless you're working with somebody that specializes in tax planning, there's a very high probability that you're never going to be able to get this done. So the clients obviously were very happy with this. They thought it would be a great idea to start taking Social Security benefits, and by the same token, try to take as much money out of their IRA without having to hit that tax liability. But then I said to them, I said, look, let me throw you something else for consideration. And they said, okay, so are you going to be able to get better than this? I said, well, I don't know, but it's entirely up to you. At least I'm giving you an extra $7,000 of income and have no tax liability whatsoever from $1, plus whatever you have coming to you from your Roth IRAs, your Roth 401ks, and your 7702 plans. So under this scenario, not only do you have a 0% tax liability in retirement, you may even qualify for Medicaid and food stamps. Now, not that these clients would do that, and we started laughing when I mentioned that, but at the end of the day, the capability is there for them to do so. But I said, look, when we first started this conversation and I created this tax map for the two of you, Mr. and Mrs. clients, you told me that you didn't have a problem paying that $2,430 of federal income taxes because you were generating $72,000 on a tax-free basis. So the only tax liability that you had was on those $50,000 of IRA. I said, well, how much more could we take out of the IRA in order to get the tax liability to that $2,430 that you would have paid to begin with had you and I or us not had this conversation as we did at the time that we visited. So I said, let's go through the exercise now. We don't have to do this. We already know that at $50,000 or an additional $7,000 of income, we're good. There are no tax liabilities, and then we can figure out what to do with that money. But let's see how far we can go and see how close we can get to those $2,430 of taxes that the clients would have had to pay otherwise. So I start increasing my IRA distributions. Okay, this is buffering at this point in time. This is buffering once again. Let's see if it finishes buffering. I want to see if it will catch up. Let me stop sharing real quick so I can try to go back and see if I can do this calculation again. For you, let me bring it right back up again. And let me put the client's Morris. Okay. John and Jack, and please bear in mind that this is not the real name of the clients. I just changed it to protect the innocent. And let me find the software again, and now I can share my screen, and now you'll be able to see it. And we're back here again. All right, so let me just go back, and we were at $22,000, and obviously we were now at 57,000. So let's continue to increase the IRA distribution to see how far we can go to meet that $2,430 that the clients wanted to pay or didn't have an issue paying at the time that they came in to see me. So I'm up to $29,000 in IRA distributions, $30,000. We're still at $1,238 only in federal income taxes. I'm up to $32,000, $34,000. We're getting closer to the $2,430. We're at $35,000. Okay, so we're at $36,000 off IRA distribution, plus the $35,000 of Social Security benefit. That actually, we just went over the $2,430 that the client would have paid at the very beginning by $6 only, so that's a nominal amount. So our income has gone from $50,000 to $71,000. So we actually had an additional income of $21,000, but a net additional income of $20,994 for the same $2,430 that the clients would have paid on an income distribution out of an IRA of only $50,000. Now, can the clients take that additional $21,000 and instead of just putting $7,000 where there was no tax liability, do a conversion to a Roth of $7,000? They can also convert if they don't have a problem paying the $2,430 in taxes. Now they can, convert the additional $21,000 to a Roth, and then we can do that for the next 8 years. Now, under the new tax law, bear in mind that it's all going to sunset on December 31st, 2025. So any tax planning that you want to do, make sure that you understand that you have a very short window in which to do so, because at the end of the day, starting January 1 of 2026, the tax law will revert back to the tax law and the tax brackets that were in place in 2017, which were higher than what they are today. So as you can see, let me stop sharing so I can talk to all of you. As you can see there, if you do proper tax planning, retirement planning is about retirement distribution. See, one of the major challenges that we have with many of our clients is that they've been accumulating assets all of their lives. So they're only thinking about accumulation. When it comes to retirement distribution planning, it is not about the accumulation rate, it is about the distribution rate. And if you can do proper tax planning, and we do offer to all our new clients, especially those of you on the call, we give you the ability to have a conference call or a video conference with us and be able to discuss to see if doing a tax-preferred retirement blueprint may be suitable for you, your family, and your business. Now, obviously, that's something that we encourage you, because a tax-preferred retirement blueprint includes having a Social Security benefits report to determine exactly when would be the ideal time, not only from a benefit standpoint, but also from a taxable perspective. When should you start taking those benefits for you and your family? It also does a 5-year tax forwarding report, which is the type of reporting that I have just shared with you, which we actually do it 5 years in advance to know exactly how much money we can start putting away into the tax-free bucket without having to increase our tax liability or maintaining our tax liability at the same level that you had it before, but now we're maximizing the tax-free income in retirement. It also comes with a retirement distribution report, which actually is going to segment the distribution planning from the taxable bucket, the tax-deferred bucket, and the tax-free bucket in order for you and your family to understand which are the best buckets to invade, when are we going to be invading those buckets for income purposes, and how we're going to do so in a way that is going to help us maximize the internal rate of return on those income distributions, not only now, but in the future, and then for the rest of your life. And then last but not least, we do a risk management report as part of the tax-preferred retirement blueprint that takes into consideration the fatal 4. These are the 4 major risks that all of us, all of you, are going to have to deal with, not only now but in retirement. The impact of a premature death, of dying too soon, the impact of living too long. What happens if you're in your 90s and you're still alive? If getting old is bad, getting old and running out of money is even worse. Do you have the ability to create, pension guarantees? Whether you have a pension or not, do you have the ability to create those? What is the risk of living too long? The risk of living with a disability, because people are living longer today, but that doesn't mean that they're going to be any healthier. So what used to kill us 30, 40, 50 years ago may not be doing that today, but may leave you disabled. The cost of long-term care in the United States has gone through the roof, and it continues to go up anywhere between 8 and 9% every single year, which is 3 times the rate of inflation. So as you get older, you have to also take into consideration not only the risk of living too long, but also the risk of living with a disability. And then last but not least is how to deal with the risk of living with eroding factors. Eroding factors are taxation, inflation, stock market volatility, interest rate volatility, propensity to consume, maintenance, financial fees, lawsuits. What if you get involved in a car accident? Are your assets protected? We also give you the ability to put together, wills and trusts. Obviously, we have affiliated partners that we work with. So when you engage us in creating a tax-preferred retirement blueprint, it takes everything into consideration, so nothing is left to chance. Now, I want to leave you with one final thought, which is a thought that I leave all of you, especially when we do seminars or webinars or podcasts, is that my job and that of my firm is to kind of help you change the way that you see things, because when you do change the way that you see things, the things that you see change. Again, thank you so very much for giving me a little bit of your time today. If you want to reach out to me, feel free to do so. We can have a conference call, determine if a tax-preferred retirement blueprint may be suitable for you. Excuse me. You can reach out to me at area code 786-766-1042. You can also email me at bert@bertsalazar.com. You can also go ahead and send me an email at bert@ tax group, taxplanninggroup.com. And obviously, feel free to reach out. You're better off just sending me an email to bert@bertsalazar.com. And I'll be more than happy to schedule a conference call with you and determine if a tax-preferred retirement blueprint may be suitable for you and your family. If you're already in retirement, no worries. Reach out to me anyways, because there may be some things that we could do in order to help you avoid those tax liabilities every single year and for the rest of your life. So again, have a great night, and we'll talk to you soon.